All right, let's get this started. I don't think we need too much context. Will Quest is a GPS Low Ventures. I don't know what think whatever. You guys, everybody knows who you are that's listening in on this. Um, what I wanted to talk about, and again, this is sort of the minimal setup. The general question is around liquidity and or the relative lack of liquidity in VC, but it's also really private capital more generally. And Will, you tweeted something back April 22nd. I'm just going to read it and then I'm going to shut up for a bit. We're going to see more GPs distribute private stock to LPs, and those LPs will hire folks to help manage the liquidity. And everyone will forget that this is exactly how it worked in the 70s, 80s, and 90s with less liquidity and more fees, because back then we just used the public markets. This is the same story with growth capital, too. What do you mean by that?
Well, which part? How do you want me to go about unpacking this?
I mean, all of it. I guess like in other words, I can ask specific questions, but first it's like generally, what are you describing? What does it mean? Like, how does this solve the problem? What problem is it solving for? Why doesn't it exist right now? But I would just start simply with like, what is the thing that you're envisioning happening?
That LPs are going to be given stock that they can then decide what to do with. Now, it's like a pretty simple concept. It's hilarious. There really has been a Rorschach test. I was probably with 50 small fund LPs yesterday. And like, it's very funny where everybody's mind goes. A lot of LPs are like, oh, that means I'm going to just get handed shitty assets that I have to deal with. It's like, oh, are you in shitty managers?
Maybe.
Like, it's interesting what their fears are, right? So listen, my take is like we've just been slowly recreating the public market that went away over the last 15 years. And some of the work we did at Industry Ventures 20 years ago, 15 years ago, is like began this journey of recreating a lot of the capital and liquidity you had in the public markets privately. And so that's just kind of my North Star. Is like we're slowly just going to get back to how we do things. And I think so that's kind of the macro view I had on it. Then the bottoms up, he was like, I know a bunch of discussions where GPs don't agree on whether they should be selling secondaries or not, right? Some people want to hold forever. They don't think price is right. And that's holding back liquidity, right? And so how do you solve that? Is you just give everybody the stock and let everyone make their own decisions, which is like hyper logical. The idea that you have hundreds of people at a certain point, right? Aligning incentives for a decade plus on price and liquidity. Just like, if you say that about anything else on earth, you're like, yeah, that doesn't work.
Right. So okay. So like, fine. So like, what you're saying is like one element of this problem here that could be an unlock is that there are LPs they want liquidity, they want to sell, GPs don't. They want to hold. And like currently there's no way of resolving that dispute. Is that fair? It's just like
the GP just holds.
And so like like mechanically, how does this work? Do you just like take the entire fund and just say, okay, we'll keep 20%, you get the 80%, pro rata according to your LP stake, and then you're on your way? Is that how it works?
When a company goes public, right? You go, yay, company went public. I mean, there's like rules in the docs about the securities you own, but you then go, this is great. Everybody gets their stock, right? And so then you take what was in the fund's name, it goes in the name of individual LPs, and they're sent their pro rata shares based on the waterfall of the fund.
Right. But the forcing function there is the fact that the company went public. In this case, like what's the
forcing function? That's not even a forcing
function,
right? Plenty of funds hold. I guess this is the thing. We need to stop seeing it as two different things. It's the same thing.
Okay. But I mean, in other words, I guess the realization event in the going public case is driven by the company itself, right? The company says, we are now in the position to go public. We're going to do a roadshow. We're going to hire bankers, all that stuff. Whereas like what you're envisioning, there is no necessary liquidity event that's gone on, right? There is like, or maybe there is. I don't know. Like, in other words,
again, I think these are like people are being overcomplicated about it, right? You go public. That's not actually the event. The event is like, oh shit, it's pretty easy now to sell my stock. There are lots of different price points you can pick because we are a public company, right?
Mm-hmm.
And you can do two things at that point as a fund. You could either like hold and take the risk, right? And then you get into the debate of are LPs paying you to be a public equity manager? Usually they say no, right?
Right.
Or you can distribute. So you can either make a price decision, go to cash and give it to LPs, or you can distribute it in kind. So like, and it's not even the IPO that's the catalyst, right? There's a certain point where you're unlocked enough to do it and you figure it's a price that you like roughly on paper think is fair for the carry waterfall. So I just think it's semantics that it's like some wildly different paradigm. Really, what matters is like everyone's like, yeah, but that's like easy to move the stock and easy to get liquid in it is really what people are saying, right? Of like why it's so different. So the answer is like, okay. And you'll see, like I also tweeted this, like, let's make it easier to move the stock. And it turns out a lot of the NAV in venture is almost as liquid as a lot of public companies.
But if it's as liquid, then why isn't it trading now, right? I mean, there are
Because
secondary
because
funds.
because the GP might not want to sell.
So the GP won't, but then you're also saying that the GP will block. Like, why can't the LP sell its stake? Or because that's not
They don't own the shares. The shares are still in the fund, and the fund is controlled by the GP.
right. I guess so. They don't have the specific share. So if an LP were to sell its stake, let's say to a second to another, somebody else who says, "I'm just going to buy your entire LP position," so it's
Which
the issue
definitely
there is,
happens and it's very doable, right? But then like
yeah,
you're blocking out about all the stock you own and maybe not the one company you think is like no longer a call option and fairly priced equity.
got it. I see. So in other words, like step one here is picking the winners anyway. We're not talking about like, all right, the fund has hit year 12. We're going to take all the equity that we own and we're just going to distribute it at 80/20 and everybody goes on their way. It's specific names.
You can do it all the ways. And to be clear, like this has happened. I've been involved in situations where funds had to wind down and cut the remaining equity and everybody like, so this is like, I'm just saying this is going to happen more. So like structurally this happens. Two, who really cares about the long tail of NAV? Is it an admin problem? Sure. But like everyone gets very wrapped around the handle of like, I'm being given a bunch. Like, yeah, it's out of the money NAV that no one cares about. And would you trade that ability, right, for you're an LP with a ton of Stripe exposure at 95 billion to make your own choice on liquidity, right? And so I'm much more envisioning it the same way a company would go public and be a winner in the portfolio. And you can either, as the GP, make a price decision for your LPs, right, or give them the stock and let everybody manage their own individual outcomes.
Interesting. And so, okay, so fine. So I get the concept. And why doesn't it happen now? Like, in other words, why can't a GP go ahead and say,
You can't.
here's what we're going to do?
I mean, the answer is like a lot of fund docs. You need to amend them in order. It's called an in-kind distribution, and you need to amend the fund docs to figure out what kind of assets you can make an in-kind distribution of and how you'll value them. So, like, there are some structural limitations that we need to lift, but a lot of this is just like it violates norms that are out of date.
Or right. Or it's like, I mean, I'm just trying to think how it would work. Like, so you're the GP, you go make the market. You find somebody who's interested in the name at a price that, makes a return. You say, you go back to your LPs and say, look, I want to continue to hold this, but I want to give you guys an opportunity. It's like, it's almost like like a tender offer kind of thing. And they can either choose to flip their equity to somebody else, or they can continue to hold it with you, just like you hold it. Or is
Yeah,
that how it works?
like the simple way to do it is we're distributing stock. We, the GP, are taking stock, right? If you would like the stock, rad, we will give you the stock. If you don't and you would like cash, right, we can move it into a 0 and 0 vehicle, right? That like will responsibly take on the burden of finding liquidity for you. Now, the way this ultimately ended up playing out in the public markets is you ended up with venture services desks at all the major investment banks, right? That would count CalPERS as a client, right? And they would go, right, we will receive the distribution of Google stock from Sequoia on behalf of CalPERS. It'll go into an account where we talk to someone at CalPERS and they either want to make buy and sell decisions, right? Or our brokers will go find orderly liquidity. Like
Interesting.
that is how that's like a well-trodden path that at this point is largely commoditized. And I don't understand like why we wouldn't just repeat that history too.
So I keep asking the same question. Like, so you're like, the only reason it's not happening is, okay, so there's some legal work to amend the fund documents, but just cultural, like,
It's a cultural problem. It's the same way when we said that you're going to need secondary liquidity in 2008. Everyone looked at us like we were cross-eyed.
because there's just one path. Like, they don't know how to be the only, unless public market
Everyone's like,
investors.
nobody sells privately. It's like, well, listen, companies have always done secondaries in years 6 to 8. It just happened in the public market. That has gone away, right? We still need that liquidity, just in a different form or in a different venue, right? And over 15 years, that's now so accepted that like, I don't know, it makes headlines.
So,
And
okay, so
I don't know why we wouldn't just keep extending the analogy, parallels, whatever.
one of the, like, I guess, like, one of the things that you sort of flagged is like the GP needing to get its carry and maintain control. So, like, in other words, what does that mean? Like, I know what it means functionally. In other words, the GP may want to decide to hold the LPs want to sell. But why is that? Again, like that seems like an easily solved problem, or like that doesn't seem to be like a blocker.
How do you solve it?
You distribute in kind. Yeah, exactly that.
Yeah,
I mean,
this is the
yeah.
this is why you're going to see more. Again, this is not like something we're planning on doing. I'm just trying to foresee where the market is going.
Hmm.
I honestly didn't think this would be that controversial, but everyone seemed to like have a very strong opinion on it. But
It's more like I'm trying to figure out like how it's different from an ordinary like secondary sale. Like where is like, and then the other part that was interesting was like, which we can get to is the second part is like, if we can't get the stomach take, but companies public earlier, then we need to just finish building the rest of the infrastructure we had. Morgan Stanley's venture services group is going to crush this. So like that part too, like what's the missing infrastructure? I guess it's two parts. It's like, okay, the first part about taking public companies earlier, that presupposes that companies could go public provided VC had the, and venture backed companies have the stomach for it. So I guess like what does that mean? And then the second part is like, if they don't have the stomach for public, there is this other private route, but that requires some other plumbing. But what's that plumbing? So I guess it's a two part
it's all
question.
there. It just needs to be accepted and scaled. Like this happens. It's just not happening at enough scale, right? Where the friction and the cost of the friction goes down dramatically enough, right? It's kind of one off and bespoke, but like the legal rails are there, the technical rails are there. You can do this. And listen, I've been very vocal for a long time that like we're doing a lot of effort and putting a lot of fees on recreating a healthy public market privately. I wish we,
Yeah.
I wish we weren't, but I'm kind of done fighting that. You know what I mean? Like you can only tilt in windmills. And so if we're gonna just say public markets are structurally changed forever and we're gonna stay private for 12 to infinity, right? We've already solved the primary capital side of that. And frankly, we've solved a lot of the liquidity side of it. People wish they had better bids and different names, but like the high quality names have strong bids. There's
Yeah.
no Coach would love to put another $1 billion in straight. You know what I mean? Like these guys have deep
Yeah.
pockets. There's liquidity. So why don't we just finish rounding it out? And in-kind distributions were like a strong feature of classic old school venture capital.
Hmm. And so I guess so now the only way secondaries are happening is just the fund sells its entire or some portion of its share, but it doesn't keep, and then it takes cash as part of its carry, but it doesn't have the option of just like holding its part
Distribute
into
that.
specific.
Like theoretically, a GP could go back in the private market and buy. Like so, you could do it that way. Also, I think that ends up adding even more friction and room for disagreement amongst everybody. I mean, you
Got
can
it.
do it other way. I just like it. Just seems like pretty. It rhymes with history and pretty straightforward.
Right. But I guess like so the other part of it too is like I don't know what is the primary driver of clearly one driver of the liquidity portion is just like there is no price that anybody is willing to pay for a lot of these names that would generate meaningful returns, right? That doesn't solve this, I don't think.
No,
Yeah. So like that's a separate problem. So this isn't like a silver bullet, a massive unlock, but this is at
I'm not
least
going to
say,
make a
okay,
bunch of people like the price of your stock you want to sell. Like that, like is what it is. And I actually think free markets are pretty efficient. And it's not like, hey, put more capital in the private markets, and all of a sudden there'll be a bid for my asset I like.
right, exactly. So okay, so like when you say like, we can't get the stomach to take companies public earlier, what does that mean?
I mean, it's the feedback across the valley. Like nobody wants that level of volatility, that level of being under the microscope, that level of like quarter to quarter accountability. Which I can make. I get all the arguments. You can make them in both directions, but like nobody wants to deal with right the apparent downside or like, the assumed downsides of being public seem to outweigh the upside to everybody, and so we've decided that collectively the best assets could just stay private forever.
Right. And I guess, but I mean, like the benefits, of course, of like all that exposure is more liquidity. So how do you bring that? Like, how do you bring how do you grow the private markets in such a way like how do you get the same liquidity benefits of a quasi public market without all of the reporting and over, or is it just you recreate your own versions of the SEC like rules, like what does that even mean, like?
I don't even think you need to do that. I mean, I think if you have more supply of Stripe stock, I think you'd have more traditional public equity funds with sleeves to do this, lining up to buy it from Morgan Stanley.
Got it. But so I guess it's still a fairly limited universe of names that would even be trading basically. We're not talking about like,
We don't know is the answer, but like, yeah, I'm not solving for the 5,000 companies out there. Like again, this,
yeah, right.
this is why it was like a Rorschach test. Like in my mind, and we're talking about SpaceX. You know what I mean? It's like you guys, which is hilarious because if you look at the NAV of venture, it's like in 50 names. You know what I mean? There's like 50 names that matter, and
So
those,
$3 trillion worth of unicorn valuations, basically. Yeah.
yeah, and half of that is in like 8 names that everybody loves, and the other half is like in speculative. So like, fine, I'm sorry, I'm only solving for half of the NAV in the venture ecosystem.
Right. Yeah. And I guess, I mean, and there is no, I mean, the other thing I guess the other thought would be is like, okay, and this has to do with, I guess, the European waterfall versus like you could, in another context, you might say, well, I don't want to let the GP pick off one name. I want to see how the entire fund returns. So then you can calculate 20%, but that
I
doesn't
mean,
really
this
matter.
gets really deep into the weeds. Like nobody wants to hear me talk about LPAs and waterfalls, but like it actually matters.
Yeah. I'm a former lawyer. Like, yeah, it definitely matters.
Well, so like
It,
forever, the way it worked was like, hey, if your fund is in the money on paper and you get something liquid, you can take profits against the full NAV, right?
yeah.
And it actually works pretty fine. There are clawbacks. Like there's a bunch of things in there where if you don't end up printing the money, right, that you owe it
Ways
to,
to get
like
made whole.
it
Yeah.
generally works. And then there was like a 2-year period where that was really hard, the dot-com bubble.
Yeah.
And so we
Okay. So,
completely wait. So after a 2-year period that is like largely anomalous, we totally over rotated and moved to the point of like, you can only take profits when I'm liquid paid back through the hurdles.
yeah.
Like the pervert, which like makes sense. I get it. That feels good. But the perverse incentive is I'm just going to hold, like my incentive is like, I'm going to hold for as long as I can to be through all the hurdles before I give you any liquidity. Cause I don't know, like I'm not counting all my chickens. So if I have something I know that might over 12 years blow through all my hurdles, I'm going to hold on to it.
Yeah.
Right. And then you combine that with the fact that like I can't take stock either. So I'm going to hold it until I think it's at like a maximal point where it's no longer compounding at a certain price. And it's like not shocking that we're in a point where where like
yeah.
low quality names aside, high quality names are illiquid. It's like that's the incentive.
So yeah, no, it makes perfect sense to me. So I guess like right, so just good. So now like, someone narrate the scope. It's like this solution would apply really to like some of the names that are already trading in the secondary markets, whatever's SpaceX, Stripe, OpenAI, what name them, but like it would just be more, right? In other words, there'd be even more liquidity to those names.
Yeah.
That's kind of thing one.
You'd have to believe that like more supply begets more demand, like most marketplaces.
Yeah. And then like, maybe one of the second order effects would be say there's like whether there's unicorns or even just smaller companies, like still solid companies, profitable companies, but they're just, I don't know, they're not growing quickly or profitably enough to be public market escape velocity, or they're not big enough to get the coverage to make it worth their while. But would those also trade, do you think?
Probably not.
Why not? Just because like same problems, like nobody would create enough coverage for them, or they're just not worth it
Yeah,
enough.
I
Like
mean,
how would that?
I think the amount of work you'd have to get, like those trade more one-off to institutional, like those are like sponsor to sponsor sales,
Hmm.
right?
Right. I mean, yeah.
I mean, yeah, maybe you get a robust enough market. Like I don't believe in the venture-backed buyout market of software companies. Like it never bunch of incentives to keep it up. Yeah, but like if you told me trying to make up that Excel KKR, you know what I mean? Started buying $50 million blocks. Like that's like way out in the future and like has a bunch of issues, but it's all like, sure, is there some chance they would be doing block trades in mid-tail assets in order to figure out if they want to do a bigger trade? It's not
Yeah.
crazy.
Or like to put it in some broader like alt vehicle or something like that.
Yeah, I mean,
Um,
but again, I think like the key is to find assets where there is differing incentives and points of view on price. Right? That's like what this really solves. If the GP agrees it's not compounding and it's not interesting, but it's like you own Google,
yeah.
right?
And
Like,
so okay, so what's the LP objection here? The LPs say, I don't want to be holding stock or making this decision. I want you to be making the decision and making the market for me. Like what's the
yeah,
objection?
I mean, like this isn't my job is one thing, and the answer is like, okay, but you've also told me that's not my job to manage $60 billion companies, so I don't know whose job it is.
That's right. You
Right?
don't want to pay
I think
ongoing
there's
fees on them. Yeah.
I pay you to buy, manage, and exit positions. It's like, okay, maybe now, but that's like not the history of the game. You know what I mean? Like there's been points in time where that wasn't the history of the game. I think there are objections of like, oh great, you're just going to stick me with a bunch of worthless assets you take carry on. My answer is like, if they're worthless, so is my carry.
Right. Exactly.
Right,
Um,
because I'm taking paper. Um, and
but the whole
then
premise is like is that they're not worthless because they want there should be a market for them to liquidate. It's just the opposite. Is you're saying I don't want to sell, but here's somebody who wants to buy it. If you want liquidity, go get it. Just let me keep mine.
yeah, or anyone who wants to keep theirs, keep theirs. You know what I mean? Like it's just a very open, free market approach for the value of the assets.
And there's enough liquidity there. So then, what's the infrastructure then? Like, what's the piece that's missing other than like, okay, fine. So there needs to be some culture around it. But then,
Yeah, for sure. You just need to do it more. Like honestly, you spin it up, you put it in an LLC. Like structurally, it's not hard. You would like make a distribution of stock. The hardest part, honestly, is recutting the certificates of private stock in the name of everybody in the fund, and
oh,
then
that's interesting.
cap table like so that's like structurally just a pain in the ass. Though I
Right.
think
So I guess like who gets board seats and like information
no,
rights and all of that.
not even that. Sure, um, but that's like pretty clear. Like those go away when you don't own enough stock, and that's you know what I mean. Like companies go public, and you're not on the board forever. I no, it's just like
Yeah.
physically cutting the certs, being like Moses LP, Moses the GP of Moses 4 LP owns 2 million shares. Now he has 100 LPs, right? Everybody owns 2,000 shares.
Yeah. Your cap table just got a lot longer, and yeah, the number
Yeah,
of
it's
names are
like
like
yes,
yeah.
but like, can you have a clock?
Yeah.
Can you put blockers together? Like, there's a bunch of shit you can do around that.
What does Morgan Stanley's venture service group do? Like, what do they do? What's their role
Right, long term or right now?
right now? Like, why are they going to crush it? What do they do that's such
I
they're
don't
going to
know.
crush it?
I mean, but like if you're an LP, like if we have a company that goes pop, I mean, I don't know. I'm like, why I pick Morgan Stanley on every investment thing has it. Like, you have a company that goes public, like you got to get the certs, track the certs. You know what I mean? Like, understand what you own, what the restrictions are, and then what the market is for them. And so they are your broker. That I
In other
like,
words, to make the decision whether or not to sell in the secondary market
well,
or
we'll
not.
be like sell, right? And they'll get back to you with quotes and find liquidity sources and let you know, right? And if it's like $100 billion company, that's not hard. If it's a $2 billion publicly traded company, then like, you know what I mean? They'll work it for you and take care of all the logistics.
Yeah. Do you think there's any universe like where, assuming like again, I think the biggest barrier to companies going public is not like the public markets. I think it's the opposite. It's just like most of the companies aren't investable, and if they were subject to more, if that kind of visibility, people would be like, I'm not going to pay. I'm not going to pay much for a loss-making company that isn't growing that quickly. I think there's probably some right. I mean, there's some middle chunk in the middle there where they're probably solid companies, but there's not too much incentive for the equity's still underwater. So like there's a bit of an incentive mismatch there. Um, but let's assume for a moment that like there are properly investable companies, and for whatever reason they don't want the burden of the public market. Is there some universe where the sort of liquidity functions of the public market could be replicated in the private side? Like, and what would be the unlock?
They are, aren't they? Isn't that what we're talking about?
I mean, we are, but not in the same way. Like, in other words, like, where there's just like a market makers you're doing. I mean, in other words, everything seems to be one-off block trades, right? Like, okay, here's somebody who now wants to buy. I mean, I don't think this stuff is trading on an exchange. I mean, I guess there are Republic and a few of those, but I don't know how much active trading that's going on there. Um, You know what I mean? Like, in other words, I think of the defining feature of public markets is that it's in some ways it's permissionless, right? It's like I get to buy stock in some name without asking anybody's permission. It's just out there, and I do my own research and I make that buy. I don't think that necessarily is how the private markets are like working right now.
I don't know how you legally structure it.
Well, but I don't think it's a legal thing so much as like, it's some of it is informational, right? Like in the public markets, part of how you're able to do that, you can invest in a company from the outside looking in. It's just like they have earnings and right.
Yeah, but
It's like
nobody does.
coverage.
Yeah, I mean, I don't know. I think that's like a pretty pie in the sky rosy view of like how do people get to conviction on public names? Like theoretically, yes.
That's how they start. I don't think it's like that's not where they end up
I mean,
necessarily. Maybe
is your summary statement that the lack of informational disclosures impedes liquidity in the private markets? The answer is like yes.
you think there's any
I've
universe where
also said on
companies just
Twitter, private companies should do earnings calls. So like,
yeah, yeah, yeah.
I'm a
That's kind
crazy
of where I was.
bastard.
But that's where I was going with. Like, do you think there's any universe where you could get a culture shift where it's like, okay, here's the trade off. Like, if you do earnings calls and release some version of, of earnings every quarter or every, in the exchange, like you get a more active secondary market,
The answer is like
for your stock
for sure.
that you think they
I
would
don't
participate?
think anyone's going to do it because I'm not sure how it benefits the founders and controlling shareholders. But like the answer is like yes.
Wait, so what, in other words, it could be done, but you think that like the companies themselves wouldn't opt into it?
Yeah, and there's some SEC laws about like what you can do about marketing stock, right? Of private
Yeah.
stock. You have like disclosure issues.
Interesting. So like it's funny because like this is nice to sort of see what you're saying, but like it's like it is an unlock, but it's not like as massive an unlock as like it could seem on its face. It's like, okay, these are the names that everybody's interested in anyway. There's already a secondary market for it, but it could be bigger, if you could get rid of this one barrier, which is letting GPs like, you know, actually put their money where their mouth is and basically say, I'm going to continue to hold. You want liquidity, great, but I don't. Like that kind of thing.
Yeah, it's like the inverse, which is like in an abstract, the waterfall situation, and you need to exit the cash situation, like structurally reduces liquidity by not absolutely, but if there's an X chance of liquidity, like it goes down because of those incentives.
Interesting. Um, do you like have you like sort of I don't know if you've got gone down the rabbit hole of like Apollo and like those those they're sort of they're hybrid private equity, like they do want to create secondary exchanges both for like private debt and private equity. Are you familiar with that stuff?
Yeah.
Do you have thoughts, like do you think it's gonna like how that would even work, or is it just like more of the same?
Listen, everyone always talks about trading these assets increasingly, and like no one ever does it at scale. They just go public. I think liquidity and PE though is like not a helpful discount on the private capital side of private equity is not helpful because those businesses just trade and it's like an equity value business. You know what I mean? Like it's a DCF based equity value business with really tightly banded rates of return.
Hmm.
Where like we're in a call options business and some call options turn into equity and it's kind of eye of the beholder. So it's really hard. It's why like sponsor to sponsor is so easy, or you can block out of a massive LP position in CBC, right? Because like you know what I mean. Someone's like, okay, cool, I'll trade into 18% cost. Yeah, it's just like a very narrow band of It's a narrower band of volatility,
Yeah.
which makes it easier to price. And so those things can be easier to do.
Which one could be easier? You mean like the on the venture side as opposed to the
Private equity and credit in a classical sense, right? In larger cap, less innovative, lower growth names is like just a more banded return. So that's why you see so much liquidity, right? Sponsor to sponsor and now LP to LP, because you can fairly price most of the portfolio versus like where one, if I'm holding something that is a bunch of out of the money call options that haven't turned into equity value yet in venture, like that's really hard to come to agreement on. And two, because of power law, I rarely like in the early years of a fund, I don't want to pay the same for everything if I'm like coming
right?
in, stepping into the position. So it creates a bit of spread.
Right, and you want anything, you want the basket, and then once like the cards have been turned over, and you actually have some insights of who the winners are, then then you don't want to be selling the basket. It's just one or two names. Um, that's interesting. So like, I just like trying to think like again, like it's sort of keep coming back to that. Like, is there some universe where these companies can like access public markets? Like, does it still sooner or is it still very much trading? All this stuff basically trading between a fairly narrow
I'd love
subset of
there to be a
buyers and
public
sellers.
market. I would love for companies to not do Series Ds and go public. I think that would actually be long term healthy for everyone. Listen, there's a tweet for everything. I have some like LPs and GPs of growth funds should just hold hands and say, we're going to do the Series D, but publicly. Like we're just going to like same price, same size. It'll do it as a public company with lockups on the stock. So like I mean, listen, I bet the early part of my career on like the importance of liquidity and venture to make it go around and drive innovation. So there's a whole long story on why liquidity inside of year 12 is actually super important to risk taking and big company building.
Yeah.
It's like I'm all
So why aren't the growth guys like? Are they doing it because they don't have to? Because like, why would I do that if I could take down
I
this
mean,
entire
it's
allocation?
a much longer conversation. I don't want to predispose because we don't play that game, but like I think it's a better priced product for GPs in the private market, and there's a lot of literature you can look at where like the function of Blackstone that's interesting is its large cap US GDP without volatility.
Yeah, without outward volatility. Yeah, sure. Yeah, fair. And LPs like it because it keeps it simple. Um, I guess like, and so companies, I guess companies don't need it. GPs don't need it. So like, for what? Then why? Like, who wins? I guess the public wins, I suppose, because they get access to these. Like in other words, if investors don't want to share and private companies don't care because they
Right.
can make their life easier.
This is why companies are saying private longer. Like the people who win, it's like people follow incentives, and for now, what the outcomes people want, saying private longer is fine. I mean, this is
So how
all
do you
like the bit of the framework is put out there. Like, if you care about liquidity, this is a very elegant solve. And the answer is like, okay, how many people actually want to drive liquidity?
Because what else are they driving? Just holding them.
Yeah, listen, there's a world like think about it personally. It feels really good when your marks don't change in your Fidelity account.
Yeah, no. Yeah, and again, right, and like the other people, it's just like I need, they need higher returning mattresses to stuff cash, and they don't necessarily need to be generating that liquidity. But now they clearly do, right? Like
Well, they
there
say
does
they
seem to
do, and
be.
then give them a solution, and everyone goes freaks out at you on Twitter. So like, there's an interesting yin and yang happening.
I wonder if it's do they? I guess right because they fear an adverse selection information disparity. Like this is something different. If you're proposing it, then you must have an angle that they don't see, and then they're going to get burned by it. That's like it's like a distrust thing.
Again,
Um,
I don't fully know. Again, I thought it was a very innocent observation on what I see as an obvious trend line within venture, and it became a Rorschach test of sorts.
Yeah. It's funny. I mean, I guess I could see like, the initial instinct of an LP being like, I now don't want to have like 100 different names that I need to manage, but you're basically saying it's not going to be that. It's going to be really one or two.
And even if it is, it used to be that way anyway.
That they would have. Well, I mean, the asset class was a lot smaller too, right?
I don't think it meant any less important names.
Yeah. So I guess even now, right? Like I just sort of like because I think about the coverage thing. I'm like, better. What does it mean to have better coverage on private companies? And like, is there any universe where the juice would be worth the squeeze there? Because like we do have more and more data. There's a lot more visibility on private companies. From the outside looking in.
There's amazing
Whether like
it just all happens in the private capital markets. Can tell
what
you
did you say?
there's amazing the guys at JMI Equity cover the shit about mid-scale vertical SaaS companies. Like there's a shit ton of coverage. It just happens privately.
You mean like you have to subscribe to get it? You mean like they're not just putting it out? Like what do you mean?
I mean, you got it, but you buy the product the same way. Like very few people individually bought IPOs. You bought a mutual fund that bought IPOs, right? And so like your pension
Right.
goes into JMI Equity, who hires an army of VPs and associates to cover software companies with 10 to 100 million. Like it's covered.
So then why do people say coverage is a blocker? Like are they not getting enough analysts? Like I hear that a lot. You just think that's bullshit.
Yeah.
Interesting. I mean,
I think it's a capital formation problem. Like,
what do you mean? Like there's no hedge funds dedicated to this kind of thing?
yeah, everyone wants it to happen privately.
And why? So that they can play an access game? Because it's like until like, it seems like I get why GPs would like it, but then wouldn't companies be like, but I could get a better price if there's more competitive bids on my capital?
Yeah, but they get a ton of like we just recreated it all. They get 20 bids on their Series D anyway, and it turns out they're pricing everything as converts, not equity, which trades at a premium.
Hmm. But then why? Like then I mean, it's sort of like it's almost like it's not a problem, but it is a problem. Like I guess I'm just struggling to describe it. Basically, you're saying it's just like everybody's winning as it is, so there really is no liquidity. Like the issue, like you don't need an IPO market in some ways. Like
I think it's a
right.
bunch of short-term incentives that are really aligned, but long-term, it's probably not ideal.
And so everybody complaining about the lack of IPOs, you're like, what are you actually complaining about? The liquidity is there. What you're really complaining about is the companies that have no price in an IPO market anyway. That's what they're complaining about.
You said it, not me.
You've said it too sometimes, maybe not quite so expressly. I guess I'm just trying to square the circle, right? Because like the one thing you're saying is like actually there's both companies and investors have all of the allocation and free cash or cheap cash that they possibly need, and like there's no shortage of liquidity. But on the other hand, there's like this big liquidity issue, and everybody's like, why aren't companies going public? And you're just like, the reason they're not going public is because nobody needs to. So there's actually no problem worth solving at that point. So I'm just trying to think like who is the loser there, and I guess it's what I don't know. I mean, why does anybody go? Why is Google public? Just because its float is so massive, like even that at that point, it's too big for the private investors.
I mean, I think it's an interesting question. If Google were started today and not in 1997 or whatever, would it go public? Listen, I'm
Yeah, I
like a
don't
big
know.
fan long term. I think companies are better operated when they have quarterly calls. And I think you end up with a structurally long term lower cost of capital when you can access publicly traded credit and a bunch of stuff. Like, so I think the long term incentive is to be a public company. I think, unfortunately, the short, medium term incentives these days isn't.
It isn't. Yeah, and I guess
There's not a
for
lot
the
of down.
companies,
There's not enough downside. Like, there's almost no downside right now to staying private.
right? Because if you're investable, there's no shortage of money to invest,
I mean,
and if you're,
Fidelity's buying your stock anyway at Stripe.
yeah, it's funny. I mean, it's almost like you're saying there is no liquidity issue, right?
I'm
Like, there's
saying there's
plenty.
no liquidity issue.
Yeah. Okay. Good. I'm glad we got there.
I think
That's
there's a price issue.
Yeah. Right. But the price is zero, or close to it. I do think there's probably some of a structure. Like there are some misalignments where like there are companies that are not worth zero, but there's people who are out of the money have veto, right? So I think that's probably
That's
true, at
100%.
least in
That's
some
a hundred
cases.
percent. I
Yeah.
think like that's like it's a structural feature.
So how do you solve that? Like, how do you get to the like these are actually good investable companies? They just need to be recapped, but the problem is like GPs have no incentive to give permission for a recap or something like that.
I'm not. That's like a time. That's like a tale as old as time.
Hmm. Um, yeah, I feel like people have to be. I mean, we've talked about this a little bit in the past, like whether we're trying to pick off these companies, like private equity trying to reposition them or something like that. But it doesn't seem like it's gotten that many legs. Um,
I mean, every down cycle, everyone thinks that's an opportunity, and like 4 deals get done.
so cynical.
I'm not
Um,
cynical. This is just like I'm just old now.
yeah. So when you refer back to the old, like what are you specifically referring to? Like what are the olden times that you're referring to?
I mean, I don't know. We can go 80s, 90s, 2000s, 2010. I
But
like,
you weren't doing this in the '80s though.
no, but I was like, I used to ride my bike down Sand Hill Road to water polo practice.
Hmm.
My
Okay,
my
so what?
my grandfather was one of the first investment bankers in tech ever.
Oh, it's cool. I didn't know that.
And then my dad,
Who
and
was
then my dad and his partners set up a couple different co-manage like basically did tech IPOs from 88 until 2002.
hmm. That's hilarious. All right, so I didn't know that. So fine. So when you talk about like your own experience, though, what are you talking about? That's like in like GFC, like before GFC or post,
I mean,
or close to both.
there's the shit I grew up around. You know what I mean? Like the narratives and what happened. Like I joke, like the soccer coaches was like a VC, a founder, and a banker. And back when like the numbers were solid, it didn't matter. Yeah, and then there's the like I joined Industry Ventures in 2006, 2007, right when there was still a really healthy debate about whether or not 5 years to IPO was going to come back or not. We took a very strong position that nobody liked and was very hard to fund. That there was going to be, we were going to need to that was not going to occur, and we were going to need to recreate the liquidity of the public markets privately. Right, that was like the position of Slow Ventures. There was going to be a bunch of breakage as a result.
Yeah.
And we were very right for a long time. And expanded into a bunch of cool products. Like I've kind of just lived it, I guess.
So like, what do you mean by like expand a bunch of cool products? What do you mean?
Oh, industry just became. I mean, we were like. I mean, they were one of the first to do a small fund of funds focused only on small funds, SPVs, co-invest. We just kept adding on like logical features of an increasing private ecosystem, which was cool until a decade ago
Yeah.
when I left to help build Flow.
Interesting. Yeah, I mean, stuff that's coming back. I think like or like people are just going to have to get more flexible. Um, do you
But
see any
then
universe
your
like?
point is like when I say old days, I'm like I can like flip to any era you want.
Yeah, no, I believe you. I was just like trying to get context. Um, I
This is
mean,
like
are
oh
you like?
09. In oh 09, everyone's like, oh shit, we're going to go pick off, right? A bunch of 1999 venture funds, right, that are now under stress. We're going to go pick off the tail assets that are doing 25 million of revenue and buy them for 75 as a software company and do it more. And like, that never happened.
And what it didn't happen because nobody had the motivation to sell, or
Because you have
why
a bunch
didn't
of
it happen?
VCs sitting on marks in year 11 of their portfolio saying, I'm going to extend it another year and maybe we're going to get that magical M&A buy. And there's like just enough case studies of things that actually rounded the bend and went public in year 15 of the fund's life that everyone, GPs and the LPs don't want to go back to their CIO and be like, oh, we took a 40%. They wound down the fund at a 40% discount. It's like, no, keep it alive for 2 more years with no cost and see if you can, right? I mean,
Right.
it's a
And
call
it's
business.
and everybody's investing money that they can, that they don't need necessarily. Like they don't need the liquidity in the same way. I mean, I guess some people did, but I guess they would have to find one-off stuff. Um,
Yeah, the structural illiquidity with like media demands to sell is like always one off.
hmm. um, that's interesting. The Yeah, I guess, I mean, it does, right. It happens in like real estate, or, like much heavily levered, where like you actually do need liquidity or you're going to lose everything, then you can force to sell. But like, yeah, it's harder. These aren't like, heavily levered. But I guess in private equity, there can be some pretty hefty leverage that might
And that's
require
like
a forced sale.
that's like not what we're talking about. Everybody's like super long out of the money equity call options.
Yeah, exactly. There's no leverage there. That's funny. Wait, I have one other question too. So, like, do you think that there's going to be? I like this topic. I sort of think about it, but I haven't put like too much deep thought into it. Like, is there any universe where there's some version of the fund that isn't just like the typical 12-year closed-end fund, like where you have things either they're permanent capital or like just they're more paths to liquidity, or like, okay, here's a company. It's not, there's a few paths, like it's not a call option or anything. Like you can actually get to a sustainable point and we're going to distribute dividends and things like that. Like, is there a universe where that becomes popular, or is that just like, no, like there's a
Inventure.
reason why? Yeah.
So,
What about technology investing in generally?
well, this is a whole other conversation of like, what is technology investing? Is investing in software companies technology investing? The answer is like probably not at this point. But
Yeah. Everything
that's
else,
like
yeah.
other right to like. I think it's super specific. To me, it sounds like a lot of work other than just distributing stock when a company works. Like I don't right. Everyone wants to do all these complicated backflips.
Well, it's not really complicated. I guess it's just like being more flexible as to what the possible outcomes might be, and like I guess part of that is just like being a little bit more like instead of just the shoveling cash into it until it hits exit
I guess
velocity.
all
Like,
this exists. Like if you want to sell your LP interest, like there's buyers. People do this for a living.
yeah, no, I mean, like on an like maybe there's a company that's just like it gets to steady state. It's like growing nicely, and like maybe the operator doesn't want to sell it, but like you still want to return money to investors, so like you do dividends or I don't know, things like that. Like you can,
But those are just
you
also
can.
one off. That's like so far from the game. Like that's like a structural solve that's interesting. Can you take that
Like,
your equity in a continuation fund? And I was like, yeah, sure.
I guess part of it, I get, is the expectation, and it makes sense why. Like VC, like they're, in our parallel outcomes, they want every company to be hyper growth, shoot for the moon, et cetera, et cetera. But like, is there any universe where like you could calibrate those, those expectations a little bit, where it's like you have some optionality? So, okay, in theory, you could be a lottery ticket, but at some point, you may hit an inflection point where it becomes clear that you're not. So we have this other path for you that's still going to make sense for us and for our LPs. Um,
I mean, but that exists. It's like it's called JMI and Excel KKR and right. It's
okay.
TPG growth opportunities. Like these all exist. It's just a question of like, is your company good enough to meet their thresholds?
Right. But I guess they're not investing early in the same way. Like they're buying established companies. They're never the first check in to like to a three-person team.
I'm confused at what I thought you were saying. I'm a venture capitalist who owns something and it's not a runaway success, but my LPs want liquidity. The answer is like, there's plenty of friends I know who want to buy those assets.
Got it. Just flipping them out, and yeah, I see what you're saying. I mean, I think, but part of the issue, I guess, like maybe I'm making it up. It's just like I feel like part of the issue is that that's never considered. It's like not generally considered an acceptable path for like startups or founders to take. It's just like, actually we're going to run this thing as like a solid going concern. Like that's
I
considered
mean, this is
failure
the
mode.
problem when you take venture capital money. Like they keep wanting to play for call it. If you get to a point where you just have like asymptoting equity value, everyone, the problem is the like, if there's any greater than 0% chance of a call option path, the incentive of a venture capital fund is to pursue it.
Right. No, I think that's what. But that becomes path determined for some companies. Like it may be.
So don't take
Yeah.
venture unless you absolutely need it. That's a whole nother blog podcast.
Right. 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 Um. Yeah, I don't know. I do. I don't know. I guess like maybe it's some version of like can you increase the batting average and reduce the slugging percentage? Um, and maybe that's not venture anymore. Maybe that's not even possible
I mean, this
because
is
it
like a
just
much longer conversation about, and then I do have to jump in a sec, but that's a much longer conversation of losing small business failure is so high anyway, right? Investing in anything, whether like the failure rate of a local pizza restaurant versus a AI startup, like is basically the same,
yeah, it's flip a coin.
right? So if you're not getting paid the upside of some, if you have less, if you don't have more than 1% chance, yeah, of 0% chance of the upside, then the math breaks. Is like that's like wrong, very in the fine print, but is generally correct. And so like I don't think there's a way to do formation early stage. Is it true? Does this work investing without having significant call option value tied to everything?
Yeah. Well, don't tell
I
Yoni that all the
think
SMB operators are
what?
not taking. He said, don't tell Yoni that all the would be SMBs are they're on an NPV basis. They're
You know, we
taking negative bets.
we know that very well. Now there's ways you can influence it. Um, but yeah, I mean that's my general take. Is like it's very hard to do
We
from. I mean,
I went.
it's just like franchises don't, right? But they have a playbook. That's like a known. You can stand up things on the back of a playbook with known economics and economic models, and not be off and running.
Yeah.
Okay.
Franchise is like one of those things is always like, I'm always puzzled. Like, on one hand, it makes so much sense. We should have so many more of them. But on the other hand, like, we don't. Like, why don't we? I don't know. Like, it seems both hard and easy at the same time. But you weren't at the last time. I'll let you go. I went to the S&B event, which was great. It was super fun. And I was just a little tired because I just got off a plane and I don't know, I asked the panelists, like, I was just like, look, you guys are all super bullish in SMBs, but none of you are building an SMB. Like, why?
I think that's like I mean, I think this is why there aren't that many. I'll leave it at for like great franchises. Like you need an, you need like a, you need a serious capitalist willing to do some hard labor.
Yeah, no, it's brutal. It's like blood, sweat, and tears and high risk.
My buddy that owns like 30 Papa John's now, the first one was grimy work in his 20s. He was like delivering pizzas. Not a lot of high agency people that like value their time that way do that.
Right, at least not with that upside. Yeah, like
All
it
right,
has to be the call. All right, man.
later,
Good to
bud.
talk to you. Thanks. Yep. Talk to you later.